We need to talk about your parents. They love you, they want the best for you, and they truly want you to succeed in life. But if you actually follow the financial advice they gave you, there is a very good chance you will end up broke by the end of this decade. The comfortable economic world they built their lives in simply does not exist anymore. Back then, you could walk into a business, shake the manager's hand, secure a job that paid for a house, and retire comfortably with a solid pension. Today, if you try doing that, you will probably get escorted out of the building by a security guard. The underlying rules of money have fundamentally changed, and relying on outdated strategies is like trying to navigate a modern smart city using a paper map from the 1800s. In this video, we are going to look at why the classic financial advice of saving money, buying a house, and staying loyal to your employer is actually dangerous in 2026, and what you should do instead. Let us start with the absolute holy grail of boomer advice, which is to put your money in a savings account and let it grow. It sounds incredibly safe and responsible, right? Your parents probably remember a time when savings accounts paid double-digit interest rates that actually outran the rising cost of things. Today, leaving your hard-earned cash in a standard bank account is essentially a slow-motion robbery, where you are voluntarily handing over your purchasing power. Let us look at what inflation actually does to your money. Inflation is the gradual loss of your money's purchasing power over time, meaning a dollar tomorrow buys less than a dollar today. If you have $10,000 sitting in a bank account, earning 0.5% interest, but the price of groceries, rent, and insurance is rising by 5% every year, you are not actually saving money. You are losing hundreds of dollars in real value every single year. It's like trying to walk up a downward-moving escalator while carrying heavy bags of groceries. You might feel like you're making progress because you see the numbers in your banking app staying the same, but in reality, you are steadily slipping backward. To survive in 2026, you cannot just be a saver, because you have to learn how to be an investor, or the system will quietly erode everything you work for. Next up is the absolute obsession with buying a home as soon as humanly possible. Our parents viewed a home as the ultimate investment and the only real milestone of adulthood. If you don't own a home, they assume you're just throwing your hard-earned money away on rent. But the housing market of 2026 is a completely different beast than the one they entered 30 years ago. Back then, a house cost maybe 3 or 4 times the average annual salary of a working professional.
Today, in many major cities, a modest home costs 10 or 12 times what a normal person makes in a year. When you factor in modern mortgage rates, property taxes, home insurance, and endless maintenance, buying a home can sometimes be a financial anchor rather than an asset. A mortgage is a loan you take out from a bank to buy a property, which you then pay back with interest over several decades. If you tie up every single dollar you have into a massive down payment, you are